Hi, I'm going to show you really quickly an example, actually 3 examples, and then tell you some of the benefits and show you how beneficial it is to add to your credit card payment minimums. So if your statement says you have to pay $250 a month or $300 a month, and you can add to the principal, you're going to pay it down substantially faster. There's a link in the description to a calculator where you can run numbers yourself. I'm going to give 3 examples so you can see how extreme and how helpful it can be. I'm just going to use an example of $10,000 at 24% credit card interest, because at the moment of May 2024, that is the average credit card rate. Okay, it looks like a lot of numbers, but there's a first example, number 1, then we'll go over 2 and 3. This represents the fact that the bank says you have to make a minimum payment of $300. So that's your minimum monthly payment. If you were to do that, it would take you 56 months. You would pay, by the end, a total of $6,645 in interest. So you're paying off your $10,000 balance plus your interest. The total would be $16,645. All right, what if you had an extra $100 that you could put towards your credit card payment? If you added $100 to your payment, making this a total of $400, it would be 36 months and $4,000 in interest, for a total of 14. What did you save? You saved 20 months, which is almost 2 years, and you saved $2,644. That's significant. Now, 2 more examples here. $300 is about, it is 3% of $10,000. It's not uncommon for credit card companies to make their minimum payments a percentage of what you owe. 1%, 2%, 3%. So that's 3%. That might be pretty high. Your payment, let's say at 2.5%, would be $250 a month. So I'm giving 2 examples here. Actually, I made a mistake on this one. Let me change this real quick. On this first example, if your payment, again, it's $10,000, 24%. If your payment was $250 a month, it would take 82 months to pay it off. That's 7 years. $10,000 in interest. So you would pay the $10,000 principal plus the $10,000 interest. You'd end up paying $20,000, and it would take you 7 years. If you just added $100 to that payment every month, you're looking at 43 months and under $5,000 in interest. So you've dropped it. You've saved $5,000, and you've saved 39 months, which is 3 years. Look at the difference. Forget the additional payments for the moment. The difference between a $300 monthly and a $250 monthly. You might think it's only $50, but at the end of the day, it's the difference between $16,645 and $23,190. It's a difference between almost $4,000 by the time you finally paid it. So you can see that the minimum payment matters. We'll talk about that in a second. But then the additional principal makes a big difference. All right, the $250 a month. If you could up it to another $250, you could add another $250. Look how substantial this is. At $250 a month, just like this one, exactly the same, takes 82 months, $10,000 in interest, total of $20,000. If you added $250, it would only take you 26 months, $2,900 in interest, $12,899. By doubling the payment here, or by adding another $250, I should say, because the math is different depending upon what the payment is, it's going to take you 2 years instead of 7 years. You're going to save 56 months. You're going to save almost 5 years. And you're going to save $7,500. So, worst case here on this chart, we're only talking about the difference between a $50 minimum and the difference between adding $100 or adding $250. But we're talking about a difference between handing the bank $20,000 or handing them $13,000. We're also talking about the difference between 82 months, 7 years, and just over 2 years. So 2 things I want to point out about this. Like I said, there's a link below for this calculator you can use and put in your balance, your interest rate, your monthly minimum, and then, if you can add principal, hit the button, see how it calculates. One thing to note is, what a lot of people don't realize is not only are you saving, for example, down here, not only are you saving 56 months and $7,420, but what they don't think about is if you've got year 1, year 2, year 3, year 4, 5, 6, 7. Okay. For year 1 and year 2, for 2 years, you're making a payment of $500 in this example, and then it's paid off. Well, if you didn't do that, you would be making a payment of $250 for 7 years. 7 years is an unbelievable amount of time. You've got an 11-year-old son or daughter, they're 18 off to college or out of the house and doing whatever in that amount of time, and it took you a long time to pay that $250. So suck it up and find a way to pay that $500 for 2 years. Save yourself $7,000 to $8,000 versus paying that for the entire 7 years. So remember, if you were able to find $500, well, what happens at the end of year 2 or 26 months? What happens is you now have an extra $500 to use every month. Save it, put it to another debt, whatever. Because at the end of 2 years, you freed up that $500 you were making. That is substantial. So the 2 things I wanted to point out is look in the calculator to see how much faster you can pay it off, how much money you can save, and realize first that you're going to free up money even faster. That's another benefit of additional payments and paying it off. The second thing I wanted you to do is go to the calculator, put in your balance, put in your APR, put in your minimum payment, $300, $250, and see if you will ever pay it off. There are minimum payments that you can put in to the point where you won't be able to ever pay it off. So the credit card company gives you a minimum payment. Don't think that means that that minimum payment is in your best interest. It usually isn't. It usually means you're going to pay a substantial amount of money over a long period of time. So you might want to make sure that you're able to increase it to something so it's not wiping you out, and at least you feel better about it. There's all kinds of other methods. I'll also put a link to a video where I describe 7 different methods, and I've got lots of videos on my channel because I'm trying to help people get out of debt, because as I always say, the banks don't care about you, the government doesn't care about you. It's up to you to take charge of your financial future and make sure that you get rid of your debt for you and your family. So I hope this has been helpful, and I hope it was quick enough, and I hope it made sense. Have a great day.